Assalamu alaikum all. I hope you are doing fine. Let's start our discussion regarding the preparation of statement of cash flow. This is one of the example which is in our book, Corporate Financial Reporting. And I'll discuss the case with you and some hidden information which we have from the additional notes to statements will be helping us in preparing the cash flow statement. So this is example about the Allen Company, and they are involved in producing the roofing supplies and insulation materials for use in house and commercial construction. So usually they are the raw material suppliers for the construction companies. Although Allen has been growing, recent lack of production capacity. This is one of the problems which they are highlighting, that they have lack of production capacity. It has caused the production delays. They couldn't fulfill the orders on time. And then some stock outs of the finished goods and a shift in the inventory mix from finished goods to the raw material and the work in process, because they have stock outs of finished goods and right now they are working, but the production is being delayed. That's why they are having a mix of raw material and work in process. Um, we have the information about the comparative balance sheet of this company. If you see here, we have 2017 and 2016 information. And if you see the order of this balance sheet, we have firstly the current assets started from the most liquid, which is cash, accounts receivable, then inventory, and so on. And at the end, we have total assets. So if we want to know that what is the order of this company's financial statement, so you can see they are preparing the statement from most liquid to least liquid format. So if this is the case, then we expect the same thing inside the liabilities and equity as well. So you can see here we have accounts payable, we have accrued liabilities. So basically we are starting from the current liabilities and we're proceeding towards the long-term liabilities and then the share capital. Now in this question, they have not provided us a complete balance income statement for 2017, but yes, they have provided us some additional information which will be helping us in preparing the cash flow statement. So let's have a look at the additional information. And as I always tell you that please keep making the notes for you that which information will be helping us in which part of cash flow statement. So I'll be using my writing pen for this purpose. So they say that the company's stock has no par or stated value. So the contributed capital is shown as one amount. So if you remember, we have studied in this chapter that the company can use a mixed format. In some companies, they can use share capital and share premium account separately. Some companies, they use a paid-in capital account. And here, if you see here, they have only contributed capital account because this company does not have par or the stated value. So it means that at whatever price the shares will be issued, that will be reported under the contributed capital account. No need to differentiate between the share capital and share premium because we don't have par value. Next is net loss for the year was 110,000. Now, students, if you remember, I told you that if we need to prepare the cash flow statement by using direct method, we need to have the full-fledged information about the income statement, as well as we need detailed information for the cash and non-cash items as well. Some of them we can extract by looking into current liabilities and current assets section, but still more details are needed. But if you see in this question, we do not have income statement with us, so it will be easy for us that if we move towards indirect method instead of focusing on direct method. So if you see here, this company has a loss of 110,000. So why they have a loss? Because we studied in the opening paragraph that this company is having lack of production capacity. It means that they cannot meet the customer demands, they cannot sell properly. Because of that, they have losses, means their sales are less. Then intangible assets have limited life. This statement tells us that because intangible assets are having limited years, so we have to amortize them. So further information is provided that they were amortized by 10,000 during that year. So make a note over here that we will get the information of amortization expense, and that will be reported in operating activity section. So for the items who will be reported in operating activity, I'll be writing O. For investing, I'll be writing I. And for financing, I'll be writing F. Okay. Let's proceed further towards the third point, which says that investment in affiliates. Before moving on, let me explain the concept that what does investment in affiliates means. It means that this company, Ellen Company, has invested in the shares of because they write equity method, so that's why I know that it's share investment. So Ellen Company has done the investment in the shares of some other companies, and when we use the word of affiliates, it means that the Ellen has investment from 20% to 50%, not more than 50%, because if it goes beyond 50%, then Ellen will be a parent company and he will have subsidiaries. It will have subsidiaries. But here they say affiliates, so it means that the investment range is between 20% to 50%. This is one thing. It represents the equity method investment. Now, in order to record the investment in affiliates, companies uses different methods. One of the method which they use, that is known as equity method. I want you people to pay attention at this point, because equity method has some specification. What does that specification means? It means that whenever affiliates provides the income to the main company or to investor, investor increases its investment account. So income increases the investment account of Ellen, and whenever the affiliates provides the dividend, then in that case the investment account decreases, equity investment decreases. This is known as equity method. I'll repeat again. Under the equity method, whenever the company receives net income, it increases the equity investment account, and whenever the company receives the dividends on these equity investments, it decreases the equity investment account. We do not have dividend income like something under equity method. We always credit equity investment when we receive the dividend. And then okay, so 10,000 dividend were received from the affiliates. So if you see here, we have net income of 80,000 from the affiliates. So 80,000 will increase the equity investment account, and 10,000 dividends were received from affiliates. It will decrease the equity investment account. Now you see here, I'm going to report two things over here. Number one, because investments are the part of non-current assets, so my investing activities are going to be affected because of it. We'll do the calculations later on, but right now we're just highlighting. And then the income that you have received from the affiliates, it might have increased your equity investment, so equity investment will get debit, and then the revenue or the income which you have received from the affiliates, that will get credit. So now this income must be reported in our income statement, so of course it's going to affect our operating activity section as well. On one side, investing activity will be affected, and on the other side, our operating activities are going to be affected. We'll see how it will be affecting. Next point is less efficient equipment was with an original cost of 200,000 was sold during the year for 40,000. It's evident that the one of the equipment was sold out, and if we compare the original cost with the sale price, we can definitely say that there is a loss. But we should not ignore the accumulated depreciation, because they said it's less efficient, so it shows that it was in use before. So let's see how much was the depreciation. So the accumulated depreciation on this equipment was 130,000. Whenever we sell an equipment, its accumulated depreciation account is also removed from our books. So ultimately, what was the book value of this equipment? If you see here, the book value was 200,000 was the cost, accumulated depreciation was 130,000. So the book value was 70,000. I'll write 70K for this. So 70,000 was the book value, but it was sold for 40,000. So it's clear that we have a loss of 30,000. So where these things will be reported, again, losses will be handled in operating activity section, and the sale of equipment will be reported in investing activity section. So two effects are going to be there. Let's proceed further towards further information. We have some more information. Cash dividend of 12,000 were declared. Now, this company is talking about its own dividends, which it has declared for its investors. So 12,000 cash dividends were declared and paid during the year. Now, dividend, as we learned in the theory, that dividends are the part under GAAP. We report dividends in financing activity section, and under IFRS, we report them in, it's the choice, either we can report them in operating activity or in financing activity. And I told you that most of the companies, they prefer to report them under the financing activity section to make the things easy, or you can say to make the things comparable or statements comparable among different competitors. So it's going to be reported in financing activity section. The company also declared and distributed 30,000 stock dividend during the year. Now, what does it mean? It means that the share capital would have increased because of 30,000. And it's a stock dividend, so it's not non-cash transaction. But we need this information to check that did company issue some new equity shares. If that is the case, then we need to consider this point. So I'll just, for time being, right here, it's considered under financing activity, but do remember this part is non-cash. NC means non-cash. The company repurchased the stock of a descendant shareholder during the year and retired the shares. So company has repurchased its shares from one of the investor, and how much company paid to him? They paid 70,000. So repurchase of shares is with 70,000, and this was actually the issuance price. At this price, the investor has purchased these shares from the company. Now company is repurchasing the shares at 70,000. So it is also the part of financing activity. Another important information is no long-term notes were retired during the year. Retired means company did not pay back any of the notes providers, or you can say finance provider through notes. So if there is a change, that will be only because of issuance of notes. So here's the end of the information which is provided to us. Now let's have a look at the balance sheet in detail, because we know the additional information. We always say the first step is to find out the difference between the cash balance. So if you see here, the opening cash balance in 2016 is 60,000, and we have ending cash balance of 108,000. So if a difference, that is 48,000. So it means that the difference or the change in the cash flow statement, we should get an answer of 48,000. K means 48,000. Accounts receivable, if you see, they are decreased during the year before. Sorry, they are increased during the year before. They were 235,000. Now we have 320,000. So again, there is an increase of 85,000. What does it mean? It means that our sales are on non-cash basis, so we have to deduct these accounts receivable from our operating activity section. I'm putting minus here because we have to deduct, but the relation is it is actually increased, which shows that we did not collect the money from the sales. Look at inventory. Inventory opening balance was 510,000, but it decreased to 450,000. So it means that there is a sale of inventory of this decrease, which is 60,000. So when we sell the inventory, inventory brings cash because of sales. So we are going to add it. I'm putting the down arrow just to show that there is a decrease because of sales. So we are going to add it. I'm putting the down arrow just to show that there is a decrease. Then comes prepaid expenses. If you see here, prepaid expenses has been decreased by 3,000. So how do prepaid expenses decrease because of adjusting entry? Let's suppose your company was having a prepaid insurance in the balance sheet. So when prepaid insurance decrease, it means that we have recorded the expense for the year. So insurance expense gets debit and prepaid insurance gets credit. So it shows that there are expenses in your income statement which are non-cash, which are actually the adjustment of prepaid expenses. So that's why when prepaid expenses decrease, we add them. Why? Because some expenses are deducted from the income statement, which were non-cash in nature. So we'll be adding them back. Do not consider the total current assets because we have considered each and every item. So if you consider the total current asset, it's going to be a duplication. So ignore it. Investment in affiliates has been okay, let's do one thing. We will first take the difference of all the items and let's try to identify the reasons, and then I'll take you towards the Excel file in which we will prepare the cash flow statement. So let's have a look at investment in affiliates. If you see here, investment in affiliates is increasing with 100,000. Originally it was 100,000, now it's 200,000. So there is an increase of 100,000. But if you remember, when I was explaining you notes to financial statements, I showed you some information about investment. If you see at the point number 3, it says that investment in affiliates represents the equity method, and the income statement reported 80,000 income from the equity investments. So if you remember, I told you that equity method increases the equity investment account when we receive the income, and it decreases the equity investment account when we receive the dividends. So let's try to check that 100,000 increase in equity investment, is it because of this income, which is 80,000, or the adjustment of dividend, which is 10,000, or we invested more? So do remember these figures. 10,000 is the income, and our dividends, 80,000 is the income, and dividends are 10,000. So let's go back and check it out. So the opening balance is 100,000. Then during the year, affiliates have provided an income of 80,000. So 100,000 plus 80,000 goes to 180,000. Then the affiliates have given us a dividend of 10,000. So 180,000 minus 10,000 comes up 170,000. But if you see here, we have ending balance of 200,000. So 200,000 means there is 30,000 of additional investment. Can you see the change? Because of income and dividend is 170,000, but the ending balance is 200,000. It means that new investment of difference, which is 30,000, was made. So that will be reported in our investing activity section. I'm writing here I, and there will be an outflow because we are doing additional investment. Then comes another effect of it, which is basically, if you see here, the dividend income which the affiliates has provided to us, that is 80,000, but we only collected 10,000 as dividend. So it means that in our income statement, income from affiliates, which was reported as 80,000, 70,000 is non-cash. We did not still collected it. We only collected 10,000. So the difference, which we did not collect it because it was reinvested in the affiliates, just like we reinvest money through the retained earning accounts, affiliates also do the same. So they have given us a net income, but dividend was only 10,000. So 70,000, which we have not collected or which affiliates have reinvested, we have to remove its effects from the income statement as well. So that's why we will be adding back this we will remove the effect by deducting this 70,000, because this income would have overstated our cash based income. 70,000, let's remove it from our operating activity section. So do remember that there will be one effect in the operating activity section as well for this. So I'm putting O over here. Then next is property, plant and equipment. So we have 950,000 in 2016. It moves to 110,000 in 2017. But remember that we have sold one equipment. So let's check out what is the overall change. So if you see here, if you directly look into the change, that is 150,000. It was 950, now it's 110,000. So direct change is 150,000, but don't forget we sold one equipment. So let's check what was the cost of that equipment. It's over here. Point number 4. Less efficient equipment with an original cost of 200,000. So the original cost of equipment was 200,000, but don't forget that they are giving us a cumulative depreciation amount as well. So let's figure out that how much changes are there. I'm going to take this 200,000 into consideration to calculate the equity part, investing activity part. So if you see here, original equipment was 950,000. We have sold out 200,000. So 950,000 minus 200,000 goes to 750,000. Right. So now there is an increase of equipment, because from 750,000 it moves to 110,000. So it means that 350,000 new equipment was purchased. Okay, so firstly remove the old one which is sold out, and then check the difference for the addition. We have accumulated depreciation as well. In the question, they did not give us any detail of this year depreciation. So this part of balance sheet is going to help us what was the current year depreciation. I just showed you the note of a sale of less efficient equipment, and there we saw that the less efficient equipment was having an accumulated depreciation of 130,000. So when we sell the equipment, out of this accumulated depreciation, the accumulated depreciation of sold equipment is also gone. So 370,000 was the original balance. Out of 370,000, we have sold out 130, so it's moved out. So our ending balance according to our calculation should be 240,000, but we get how much? We get 440,000. So 440,000, why it increased? It increased because of current year depreciation. So how much it has been increased? It has been increased with 200,000. Okay, so 200 is the current year depreciation. After that, let's proceed further towards the intangible assets. So you see there is a decrease in intangible asset. If we do not have any information about the intangible assets, that did we amortize them or not, we will say we sold some of our intangibles, like customer list or something. But in the question, they have clearly told us that the intangible assets were amortized. If you see here, point number 2, it says that intangible assets have limited lives and were amortized by 10,000. So let's check out is the difference is of 10,000. So if you see here, exactly 10,000 is the difference. There is a decrease in intangible assets. So the journal entry was amortization expense gets debit and intangible assets gets credit. So that's non-cash, right? So we have to adjust this amortization expense in our operating activity. So this is operating and this is also operating. Let's proceed towards our current assets, current liabilities and equity section. We have accounts payable. There was no information about the accounts payable in notes. So it means that whatever accounts payable are increasing, they are because of non-payments for the purchases. So if you see here, 400,000 was the original balance and opening balance, and the ending balance is 554,000. So there is an increase of 154,000. So 154,000 increase because we didn't pay this year for our purchases of 154,000. Then comes accrued liabilities. Accrued liabilities are those liabilities which are basically expenses and we did not pay them in cash, so they are payables for us. So if you see here, there is a decrease. It means that in current year, we have paid from the previous payable of 2000. So we not only paid for current year, okay, whatever current year expenses were there, they were in the income statement, so we should not worry about them, but we should consider this payment as well, because this is about our previous year's expenses. We also pay them, so when there is a decrease, we deduct it because cash outflow happens. And because accrued liabilities are related to expenses payables, so we'll be reporting them in operating activity section. So there will be an outflow of 2000 over there. Don't consider total current liabilities. We have considered the parts of them, so no need for total. Now let's look at long-term notes payable. There is an increase of notes payable. It means that we have borrowed further, and it is consistent with the investment in additional equipment, because whenever companies usually they invest, they try to borrow the money for that rather than doing the cash investments. So anyways, they have borrowed the money by taking notes, by issuing notes payable. And how much they have borrowed? They have borrowed 280,000, because this is what is increased. So it brings inflow under the financing activity section. Then comes contributed capital. We have information about the contributed capital, if you remember. This is the last point in the additional notes, second last point, sorry. The company repurchased the stock of our descendant shareholder during the year and retired the shares. So how much company has retired? 70,000. Okay, and the company also declared and distributed 30,000 of dividends, stock dividends. So share capital increased because of $30,000. Share capital decreased because of $70,000. So if there is still any change, that will be because of additional shares issuance. Okay, so let's have a look at it. Do remember 30,000 is an increase because of non-cash transaction, which is issuance of stock dividend, and 70,000 is the repurchase of shares. So let's have a look at this calculation. Our share capital was originally 750,000. Then we issued further shares. How many further shares we have issued? We have issued 30,000. So when 30,000 comes, that becomes 780,000, right? Then 780,000. Then we have repurchased shares of 70,000 from one of dissatisfied customer. So if 70,000 we have repurchased, so we have 710,000. So it means that this is the overall adjustment for the share capital, which is exactly matching. So we did not issue any additional share capital. But don't forget to mention the dividend. Cash dividend of 12,000 was declared and paid, so there will be an outflow because of this dividend. So this is how all the items are going to affect our cash flow statement. Now I have transferred this question into Excel so that we can properly prepare it. So I'm going to share my Excel file with you. Just give me a prepare it. So I'm going to share my Excel file with you. Just give me a second. So here's the file. If you can see, I have transferred here the data which we just discussed. After reading the information, we clearly make a draft of which items we are expecting in our cash flow statements. Of course, firstly, we'll be putting the title of the company for which year you are preparing. This company has a net loss in 2017, so indirect method always starts from net loss. So if you see here, I'm going to put 110,000 over here, and it's a loss, so don't forget to indicate it with brackets because it's negative. It's up to you. You want to put in brackets or you want to put it in minus sign. Both are acceptable. See, it's transferred to brackets. Sorry, minus sign. I put the brackets. I'm going to use the comma style for the values. So I have clicked on the comma, and I want the same pattern for the remaining. So later on, I'll be shifting them. Then we have calculated the depreciation when we were discussing. We took the factor of depreciation by using our cumulative depreciation account. So 200,000 was the depreciation. Then amortization, I explained you, it was for intangible assets. So 10,000 amortization expense. I'm adding it back because depreciation and amortization both are non-cash. It's better to highlight everything and use the comma for this. Okay, then we have sold the equipment. What was the sale price of equipment? The sales value for equipment was 40,000, but the book value of equipment was 70,000. So there was a loss on the sale of equipment. Now, loss on the sale of equipment is going to be adjusted in investing activity section, where we will be putting all the proceeds of sales, right? So that's why we should remove its effect from the income statement. Otherwise, it will show the dual effects. So loss on sale of equipment is how much? It's going to be 30,000. Next is the equity earnings. Affiliates have given us an equity earnings of 80,000, but we only received 10,000 dividends. So it means that 70,000 net income was non-cash because affiliate has reinvested it. So 70,000 was non-cash. It has increased our net income. So let's bring it back to the cash-based income by deducting this. So I'm going to put the bracket to indicate that it's a negative amount because I'm going to deduct it. Then increase in accounts receivable happen, and increase in accounts receivable shows that our sales were on non-cash basis. How much was that? That was 85,000. So I'm going to deduct its effects because sales did not bring the cash. Inventory has decreased. It means that we sold the inventory, so sales bring the cash, 60,000 difference. Then there is decrease in prepaid expenses. A decrease in prepaid expenses was 3,000. Expenses decreases our net income, but I'm adding decrease in prepaid expenses because these expenses was brought from the balance sheet to income statement as an adjustment. So they were non-cash for this year. Of course, they were cash in the previous year, but this year they are non-cash because it's just an adjusting entry. Accounts payable have been increased. This shows that we did not pay to our suppliers. So it means that cost of goods sold have purchases for which we did not pay. So we have non-cash expenses this year. So I am going to add it back because these expenses were not paid in cash, 154,000. Then comes decrease in accrued liabilities. So accrued liabilities were liabilities payable because of operating expenses. Previous years, we did not pay them in cash, so our accrued liabilities arises. This year, we have paid for those operating expenses. Because operating expenses are the part of income statement, so we are going to adjust these payments in our income statement. We are going to decrease these accrued expenses payments. Okay, so if you see here, these all are the adjustments in our operating activity section to bring our non-cash net income to completely cash-based net income. So these adjustments are needed. So let's sum them off. No need to do minus again because we already put the minus signs for the amounts for which we want to deduct. So just put the sum formula and I'm going to add all of them. Of course, in exam, you're going to use the calculators for this purpose. So there is an increase of 300,000 in our yes, there is an increase of 300,000 for these adjustments. Let's find out the overall effect. So overall effect is sum, and I am going to add this factor and this factor. So you can highlight all, the summation formula, or use your calculators, of course. So we have basically net cash provided by operating activities. Now let's proceed towards the purchase of, investing activity section. In investing activity section, I have already highlighted with you that we have purchased additional equipment because the company was having some inefficient equipment which was sold out. So basically two things happen for the property, plant and equipment. Firstly, we purchase. When we purchase, there is always an outflow because we pay in cash, and 350,000 was the amount which we have computed before. The equipment which was sold, it was sold for 40,000. In notes it's given, so I put whole 40,000 here. Company has done some additional investment in affiliates. Also, we calculated this amount when we were reading the statement. So how much additional investment? $30,000 of additional investments are done. And that's it for the investing activity section. So what's the effect? If you put the sum formula, look here, I already put the minus sign for the amounts for which we have cash outflows. So basically, investing activity has used the cash. And usually it is true, because when you make the investment, you have to show an outflow. When you start selling your investment, it means that you are facing liquidity issues. That's why you are selling your investments. Let's proceed further towards our financing activity section, and we find out that company has issued new notes because the company wants to borrow, so it brought the cash inflow. Then company has paid the dividend of 12,000, so it took cash, so that's an outflow. And also for one of the investor, company has paid back 70,000. So I'm going to pay back 70,000. It's also an outflow. That's it for financing activity section. Let's find out what's the difference. So if you put up some formula and let's check, basically we have an inflow in the financing activity section, and we were expecting this because we made an huge investment and we need finance for that purpose. That's why we have borrowed further. Let's find out what is the net increase or decrease of cash during the year. According to our initial investigation, which we did by taking a difference between our opening cash balance and the ending cash balance, we find out that there should be an increase of 48,000. So sorry, I'm just going to put the formula here. So cash flow from operating activity plus cash flow from investing activity plus cash flow from financing activity, and here you go, it's 48,000. If you want to get your ending cash balance, so don't forget to add the opening cash balance in it. So opening cash balance is reported in 2016, that's 60,000. So if you want to know what is the ending cash balance, that is going to be equal to sum of these change and your opening cash balance, and this is your ending cash balance, which is exactly the same which you can find in the balance sheet of 2017. So this is how you are going to prepare the cash flow statement for this company. This question does not end here because we have some discussion in point number B. So I'll take you to point B. Just give me a second. I'll show you the PDF picture of this. Okay. So point number B asks us that, let's read the question. This is the cash flow we just prepared in Excel. Discuss the relationship between net income. We don't have net income, we have net loss. And cash flow from operating activities, we find out that cash flow from operations is positive. You can see here 190,000. And the relationship among the cash flow from operating, investing, and financing. So these 190,000, 340,000, and 198,000. So they want us to compare them. be specific as the data allows. So let's try to figure out firstly the first part of part B, which says that what is the relationship between your net income and cash flow from operations. So if you see here, students, we don't have net income. Income statement shows net loss. So why do we have net loss in the income statement? So basically, this was because of the large amount of depreciation. Can you see huge depreciation expense was there during the year? Why? Because the equipment which company was using, that was not efficient. So major source of difference is this 200,000. Then also there is a reason of positive cash operating activity. Why? Because one of the huge amount of expense which was the part of your cost of goods sold, that is purchases, we did not pay for it. So income statement has a loss, but we have positive cash flow from operating activities because this expense was not cash for this year. Another important information is that in the opening paragraph, the question, they clearly reported that the company's sales have been decreased, and when the sales decreases, of course, it is difficult for the company to meet its operating expenditures. So that's another source of losses for the company. And we also know that the capacity of the production has been slowed down because of inefficient equipment. So when the equipment was inefficient, production was not up to mark, company could not provide the requirements of the customers, it could not sell as it was required, it couldn't meet the demand. These things has cost the company to have the losses in the year. But because of non-cash expenditures, we have the positive cash flow from operating activities. Another important thing is we could expect increase in receivables and increase in sales in the future, because this company has done the investment in the property, plant and equipment in this year. So the old investment was sold out, which was inefficient. So hopefully in the future years, the company was expecting to have positive cash flows. The next thing is growth in accounts receivable. There is a decrease in cash flow from operating activities because the company was not able, can you see here, accounts receivable 85,000 growth is there, increase in the accounts receivable. It also decreases, you can say, the cash sales, and the company operating activity is affected because of it. Cash flow from the operating activity is 190,000. So it was not enough for the company to make this investment of 350,000. So also company wanted to do some additional investment. So because of these reasons, company has borrowed a loan of 280,000 so that they can have positive cash flows for the years. Then another important information which we should know, that is company has to make its investors satisfactory, or you can say to meet the requirements of the investors, company has also given the dividend to its stockholders. After this, next point is we need to explain one more part of this question, which is part number C. It says that identify the two conditions in the operating section of the statement of cash flow, which points to probably that CFFO might decline next year. Means cash flow from operating activities will decline next year. They want us to identify two conditions for the next year. So let's see our operating activity section and check which things have increased our cash flow from operating activity this year, which we couldn't expect next year, and then we'll decide accordingly. So this is our cash flow from operating activity section. We are expecting that inventory will increase next year. There is a decrease in inventory because the company was not producing more, and whatever was in the stock of finished goods, that was sold out. So that's why we have a positive cash inflow because of the sale of this inventory. But in the future, we are expecting that company will have more amount of finished goods inventory and work in process and raw material because the company has purchased a plant. So when we are expecting the inventory to increase in the future, then in that case we will have a negative or you can say increase in inventory, negative, because the inventory will be stored for the future sale purposes. Another important thing is we expect accounts payable to decrease, because right now company is stretching out its payable because of the lack of sales and lack of the operating cash flows. But in future, because the operating capacity is expected to be good, so the accounts payable amount is expected to decrease. Also, we expect that accounts receivable will increase more in the future because of the higher amounts of sales. So this is it, students, about the discussion of preparation of the cash flow statement and the relationship between operating, investing, and the financing activity section. I'll upload another video for our another case which we'll be discussing shortly, and you can find it in the same place where you'll find the link of this video. Take care, everyone.